For decades, multinational corporations have played a sophisticated game with their taxes.
Some of the richest corporations on the planet using loopholes to avoid paying their fair share of tax.
The U.S. Treasury loses nearly $50 billion a year to tax
Google,
cheats.
Starbucks and Amazon answer accusations about why they pay so little tax in the UK.
While these companies operate globally, they often report lots of their profits in low-tax jurisdictions. As a result, many countries lose billions in essential tax revenue each year. In 2021, after years of negotiations, a global tax deal was unveiled to make this system fairer. But will it work? Across 2 episodes, we speak to experts about how companies and their armies of accountants perfected the art of tax avoidance, whether the plan for a global minimum tax can truly fix a broken system, and what happens now that the US, the world's largest economy, is refusing to play ball. I'm Gemma Ware, and this is part 1 of the 15% solution from The Conversation Weekly. Telling this story for us is Mend Mariwany, one of the producers of our show. Hello, Mend.
Hi, Gemma.
So, Mend, you've been digging into this nitty-gritty issue of plans to reform the global tax system for us. At its core, what's really driving these changes that we're seeing emerge at the moment?
Well, Gemma, it all comes down to 3 major problems. First, governments desperately need more revenue, especially since the pandemic. So we're talking about pandemic recovery, but also for things like climate transition, which is only going to become more pressing. Second, multinationals have basically turned tax avoidance into a sort of science. So they've got increasingly better at avoiding paying taxes or just paying a tiny amount of what they should be paying. And third, and this is crucial, our tax rules were designed for things like steel mills and assembly lines. And so the international tax system just isn't able to handle the demands of the digital economy that we live in today.
What particular challenges does the digital economy present to tax collectors?
So our tax rules had in mind companies that were physically in one place and operating in that same place. If you think about a company traditionally, it used to have a factory or office, for example, in the UK, and you could tax them in the UK. Where the product is being consumed is also where the company is being taxed. Now, in the digital economy, tech giants can make billions from users in the Philippines, for example, without having any single employee or office registered there. And legally, those countries often can't tax those profits at all. And it's often poorer countries that are disproportionately losing out as a result of those kinds of practices.
So what you're describing, you could just say is kind of, unfortunately, the status quo of how the global economy works. But how do we get from the point of recognizing these problems to actually trying to find a solution for them?
Yeah, I mean, for years, there's already been a lot of pressure from researchers from developing countries and also from groups like the Tax Justice Network, which is a global network of activists and researchers. And they've been investigating tax injustice around the world. But a few years ago, the OECD, which is the Organization for Economic Cooperation and Development, and the G20 finally got serious about this issue too. And so what started off as a theoretical debate has eventually turned into a real proposal for a global tax.
And what's the fundamental idea behind this global minimum tax?
In a way, it's all about what's called the race to the bottom. And you'll hear this term being thrown around a lot when people talk about a fairer tax system. So up to now, a lot of countries have competed for investment by offering really low tax rates just to attract companies. And the new OECD rules say it doesn't matter where a company is registered for profits, they'll have to pay at least 15% somewhere.
I'm going to be handing over to you for this episode, Mend. So where are we starting this story?
I thought it would be good to start by trying to understand how tax injustice affects countries around the world. So the first person that I reached out to was Annette Alstad Satter, a professor of tax inequality at the Norwegian University of Life Sciences in Oslo.
My goal is to change the world number by number and law change by law change. I'm a tax professor, and usually people think that's very dull. But that kind of changed after Panama Papers, which was a big data leak showcasing how people hid their wealth, and wealthy individuals or powerful politicians had hidden assets and showed the hidden structures.
Mossack Fonseca stands accused of offering tax evasion and money laundering facilities to tens of thousands of clients.
What I want to do is to show how structures and systems can be exploited in a kind of unfair way. Reduce taxes for some, meaning that we have less resources to pay for the common good, and the rest of us have to pay more in taxes to finance what we need in education and health and all of that.
Annette has been involved in a project called the Atlas of the Offshore World, a website designed to make complicated financial data accessible to everyone. The goal is to help journalists and civil society hold governments to account and drive change by exploring the connections between offshore wealth and corruption. In discussions about global tax challenges, the two terms that often come up are tax avoidance and tax evasion. Although they seem similar, there are significant differences between the two. In essence, tax evasion is the practice of illegally avoiding taxes by hiding money. And tax avoidance is the use of loopholes or laws to one's own benefit, to avoid paying taxes as much as possible. Tax avoidance is not illegal. It's essentially what companies pay armies of accountants to do for them. But both tax avoidance and evasion have far-reaching impacts.
First, you can say it's about fairness. Because if some pay less than their fair share of taxes because they have tried to evade or avoid them, others have to pay more in order to finance the same goods. That's unfairness. So you have less tax revenue. It can also affect competition. So you have some companies, like the big multinationals, who legally reduce their tax payments. That means that they can then offer the services or goods to a lower price than other competitors and still make money. So it affects the structure of the economy. It can affect competition, unfair competition between those who participate and those who don't.
In a global setting, Annette says, tax evasion and tax avoidance undermine the ability of developing countries to finance their own development.
What we really want to do is make people, like country in the global south, able to finance and fund and develop themselves and not rely on foreign aid. And what you need for that is good structures and a tax system.
But finding and gathering the relevant data on multinationals requires cooperation across countries, and that's extremely difficult. So tax researchers like Annette often rely on other means.
What we are dependent on is basically getting a glimpse behind the veil of secrecy that bank jurisdictions, secret bank, or other tax havens offer. Because what tax havens or secrecy jurisdictions offer is basically one or several layers of secrecy so that the taxman can't look into it. And then we have, in collaboration with journalists and others, been able to look at leaked data.
The so-called Panama Papers, believed to be the biggest data leak in history, are exposing how some of the world's wealthiest
Pandora
and most
Papers have
powerful
exposed
people
secret financial accounts of billionaires, celebrities, politicians, and some
million
35
documents
current
known
former
as the Paradise Papers, and they reveal the tax affairs of rich and powerful people.
According to the Tax Justice Network, in 2023, individuals and multinational corporations underpaid approximately $500 billion of taxes combined. Because multinational corporations tend to handle much larger amounts of money than individuals, it's generally more lucrative for the taxman to go after multinationals rather than targeting personal accounts. But the methods which corporations, especially bigger ones, use to shift profits across borders often rely on significantly more complex loopholes and tax planning. To understand exactly how multinationals take advantage of existing tax rules, I reached out to Tarcisio Magalhães, Assistant Professor of International Tax Law at the University of Antwerp in Belgium. What are some of the most significant loopholes in international tax law that exist, and how are they exploited?
Just to start off, I wanted to say the loophole is not a completely defined term, and it's not a legal term either. So when we talk about loopholes, we usually use it in a more colloquial way to refer to inconsistencies and mismatches between tax systems. And that can be both intentional, sometimes, when countries use their tax systems to create opportunities for others to obtain a benefit. It can be unintentional when legislators cannot predict all possibilities or cannot see all forms of economic activity that will arise in the future. And it can also be just the fact, when we put this conversation into a global context, that the existence of different tax systems will inevitably create loopholes by the mere fact that each tax system operates in their own way. Now, if we think about the exploitation of loopholes, which is the bread and butter of tax lawyers and tax consultants, it's a very creative exercise that we call tax planning, to use a general term. And because it is creative, the possibilities are endless.
One method multinationals use is referred to as income shifting or income routing,
which means that you set up the structures of your company between different countries in order to shift income from high tax jurisdictions into low tax jurisdictions. And then there are more fancy names that we stumble upon sometimes, such as this thing that we call a double Irish with a Dutch sandwich strategy. And it is this idea of taking money that is in country X, routing it through country Y, and then bringing it back into country X again, so that you can take benefit of some tax treaty or some exemption or other benefits that the countries provide.
The double Irish with a Dutch sandwich strategy is named after Ireland and the Netherlands, and it works like this. First, companies set up shop in Ireland to take advantage of its low corporate tax rates. Then they route money through the Netherlands, where special tax treaties let companies move their profits between countries without the usual cross-border taxes. That's what experts call withholding taxes. One example of the double Irish with a Dutch sandwich strategy involves Google. For years, the tech giant routed global profits through an Irish company that's tax registered in Bermuda, a zero-tax jurisdiction. That way, it was able to avoid paying taxes on international earnings in the US, where it's headquartered, and shrink its overseas tax bill too. But following years of pressure from the European Union and the Irish government, Google eventually announced that it would stop making use of the loophole in 2020.
Another classical form of planning, and one that has been addressed more recently, are hybrid mismatch arrangements. Sometimes companies play with the fact that countries classify legally companies differently for tax purposes, so that one company can be considered by one country as non-taxable, while for another country it is considered taxable. But those are just examples. The possibilities, as I said, are many more.
What about double taxation treaties that are meant to prevent the same income from being taxed twice, for example, in two different countries? Do they also sometimes open up loopholes?
The thing with double tax treaties is that they were designed initially, and this goes all the way back to the 1920s, to promote capital flow between countries. Even without going into details of each specific rule, the fact that they were designed to avoid double tax in itself create the possibility that you would play around and pay even much less. We don't live in a world where all tax systems have the same rate. So as long as we live in a world where we have some countries taxing at 30%, others taxing at 5%, when you create a possibility that you're going to be taxed only once, you're going to try to get the 5%, or you're going to try to get the 0 if it's possible. This is something that we learned throughout the years and more recently became a topic of debate.
To prevent corporations from avoiding taxes in higher jurisdictions, countries will often establish bilateral tax agreements or anti-avoidance rules with countries that have lower tax rates. These agreements specify where companies are taxed and at what rate. But companies can still take advantage of these treaties for their tax planning. Take, for example, a treaty between Canada, where taxes are high, and Luxembourg, where taxes are low.
There was this case where basically the structure of the company was two investors, two partners based in the United States that owned this company called Alter Energy Canada, based in Canada. There was the holder of various assets, oil and gas assets. When you sell assets and they increase in value, there's a capital gain and usually you pay tax, right? In Canada, as a high tax jurisdiction, there would be a high charge there. What did Alter Energy do? Instead of selling the assets directly from Canada, they first established a holding company in Luxembourg that would hold the assets of Canada. Because there is a tax treaty between Luxembourg and Canada, and this tax treaty allows for an exemption on capital gains, the company was able to sell those assets that belong to the Canadian company through the Luxembourg company and then get access to the treaty. Of course, the tax revenue in Canada was not satisfied with the situation.
In 2021, the Canadian Tax Office took Alter Energy to the Supreme Court, arguing that it violated law and was not entitled to the tax exemption.
But in the end, Alter Energy was able to convince the court that, look, there is a tax treaty between Canada and Luxembourg. Canada knew about this exemption of capital gains. So why is it that I cannot use this mechanism, right? And the court bought the argument. The court kind of suggested that the treaty shopping, which is what we call this kind of strategy, is not in itself wrong. And the court would go on and say it's a form of promoting investments, and Canada knew about this situation with Luxembourg and still enter into a treaty with it.
The Supreme Court dismissed the Canadian government's appeal, saying that when Canada had ceded taxing rights to another country under a double tax treaty, it could not invoke the general anti-avoidance rule to backtrack on that agreement. In short, a deal is a deal, and Alter Energy was allowed to continue taking advantage of the tax exemption. Sometimes, Tarcisia told me, creative tax planning isn't always about reducing taxes.
Sometimes it might be beneficial to be more exposed to tax. And this would happen when the companies are in a loss situation. If you're in a loss situation, maybe you want to deduct more or you want to claim those losses more. So having access to different jurisdictions where you can claim twice is also a benefit. For that, we can give another name that we call double dipping. Right? So it's this idea of taking benefits here and there. But most of the time, companies will be trying to reduce their tax burden.
Are there any particular sectors or industries that are possibly more prone to tax avoidance? Can we see tendencies there?
Nowadays, the sector that we talk about the most, the tech sector, or the digital economy, the major digital economies. So we hear a lot about the big data giants. So those are the major tax avoiders. And there's a quite simple reason there. We have a digital economy. The digital economy is non-physical.
Our tax systems were built for a world of smokestacks and shipping containers crossing borders. But in today's economy, much of what's traded is data with no tangible product in one physical location.
Because these companies are digital, they can easily operate around the world, make profits everywhere, but not be taxable everywhere. Right? So they are the focus of attention. Nowadays, we also see that all companies are digitalizing. This is a problem that in international tax we usually call ring fencing, to try to isolate the digital economy from the rest of the other sectors of the economy.
By legally isolating certain parts of their operations, corporations can limit their overall tax liabilities.
If we take a sector that was traditionally physical and tangible, mining, you're extracting minerals from the ground. There's nothing more physical than that, right? But we see major mining companies, they're becoming more and more digitalized. They're starting to use robots, so they don't need labor force as much as before. They don't have people working in the mines. They use drones, and these things can be controlled from anywhere in the world by the mere use of a keyboard and a computer.
While there is still no firm evidence linking digitization and mining to tax avoidance, research on the topic is emerging, and Tarcisia highlights a growing risk. When mining companies operate drones, robots, or AI systems remotely from low-tax jurisdictions, rather than the mine's physical location, it creates new possible avenues for profit shifting.
You can shift profit to a different jurisdiction outside the jurisdiction where the mine is located, because you're going to say a lot of the work that was done by this mine was done by these robots that were managed, controlled, used from a jurisdiction that is not here. So we see this phenomenon expanding to many more sectors, but definitely the tax sector is the one in the spotlight.
In an increasingly global and digitized economy, operating in a system of mismatched tax rules, it's become harder than ever to pin down where profits are made and where they should be taxed. Multinationals have the resources to reorganize. If one door closes, they soon enough find another. Some countries in the EU and the UK have imposed digital service taxes as a sort of band-aid solution, only to face US trade retaliation this year. But the ones losing the most are often developing countries. For decades, they've been excluded from writing the rules, and they've often faced pressure from global institutions not to challenge profit shifting at all.
A lot of times, because they were influenced by global north institutions such as the World Bank or the IMF, but also missions that were sent by the World Bank or economists from the north that are sometimes sent to the south to tell them how they should design their tax systems. If you want to grow, if you want to develop, you cannot tax capital.
This reveals a deep contradiction in global tax policy. On one hand, many developing countries were steered into designing simple tax systems that avoid taxing capital in order to attract investment and spur development. On the other hand, those same nations are later criticized for acting like tax havens when they don't tax capital, even if richer countries use similar tactics to attract investors.
So I try to avoid the term tax haven because if we go really deep into it, we might end up calling all countries tax havens, right? All countries engage in tax competition. So why is it that we ostracize these small islands? They're poor and a lot of times have no other option. And then when Europe and the United States uses all sorts of mechanisms to attract capital that we know that they do, they're not as much criticized.
Lower-income economies often rely on corporate tax, which is charged on the income a company earns after expenditure. That's where Tarcísio says the tension really lies.
Why the corporate tax? Because those are investments coming in from outside. Those are investments coming from rich countries to exploit or to sell, to do business, to do activities in the South.
But even when a country wants to tax foreign assets, it can be blocked by treaties signed under international pressure. Tarcísio highlighted a landmark case involving the telecoms company Vodafone in India that has dragged on since 2007.
In a specific case, it involved a holding of Vodafone based in the Netherlands and the government of India. What happened was Vodafone wanted to acquire these assets and companies based in India. Again, instead of acquiring them directly from India, which would trigger capital gain, and India would have imposed a tax on it. But instead of doing it directly, it did it indirectly by buying a company that owned the assets in India, located somewhere else. The government of India was not satisfied with this and said, this is just a way to go around the rules. And they tried to charge them. They took them to court. But in the end, the Supreme Court of India ended up ruling in favor of Vodafone.
Even when a country decides to levy taxes, it's up against multinationals that are faster, better resourced, and always one step ahead.
Multinationals are very agile when it comes to responding and rearranging and rethinking what they're going to do. They're always with an eye out on what's happening in terms of tax before it happens, all the movements. Basically, there are three ways that they respond. One is through political lobbying. The other one is through corporate restructuring. And the third one is to legal battles. All of them require a lot of resources, as you can imagine. So we're talking about companies that are resourceful, that can invest in those things. So if you think of one example of restructuring is what we call tax inversions. If you try to tax a company in one jurisdiction, this company has its headquarters in that jurisdiction. It inverts, so it means that it changes, it merges with a company in another jurisdiction, and the headquarters is placed in the other one, and the previous jurisdiction where the headquarters used to be becomes a subsidiary. So that's in a tax inversion. You do that, so you're trying to escape some form of tax that is imposed on the headquarters.
After decades of playing cat and mouse, the world finally has a response. In 2021, the OECD's global tax deal marked a turning point. In response to mounting global pressure, the OECD unveiled a new global tax framework, a set of rules aimed at overhauling how multinational companies are taxed around the world. The reforms could force multinationals to pay their share where they operate, not just where they park their profits. In episode 2 of this two-part series, we'll break down exactly how these rules work, the obstacles standing in their way, and why a second Trump presidency could derail progress entirely.
The genius of the global minimum tax is that it doesn't require everybody to agree on it in order for it to work. A smaller number of large economies can make it a reality by moving together. The OECD has brought into being this mechanism of exchange of information, which has great potential for all countries. And we've seen significant benefits for not just higher income countries, but also some lower income countries from participating in that already.
This episode of The Conversation Weekly was written and produced by me, Ment Mariwani, with sound design and mixing by Eloise Stevens. Our theme music is by Nita Saal. You can email us directly at podcast@theconversation.com. You can sign up for The Conversation's free daily newsletter by clicking on the link in our show notes. The Conversation is a non-profit news outlet dedicated to sharing the work of academic experts to help make you better decisions. If you like what we do, please support us at donate.theconversation.com. And please rate and review the podcast wherever you follow us. Thanks for listening.